Okay, so I'm trying to do a couple of videos on topics that I feel could come up as an essay, and one of those is investment appraisal. So for the last 2 years, there have been 14 marks on calculating net present value and calculating payback period, and then an associated 6-mark question. Now, whilst you can never say never, they won't do that again, I'll say the more likely assessment of investment appraisal this year is a 25-mark essay, or they ignore it. They always can, but for me, I think it's a good topic that could come up. And so what I'm going to do is a quick video now on net present value and how you could use that in an essay, then do a separate one on payback period, and then another one on other factors that you could use when determining a choice in an investment appraisal essay. So first thing to consider when you're looking at net present value is the fact that it takes into account the time value of money. So we look at this idea of the cost of capital. And so what we mean by that, if you're not sure, is just the fact that a pound now is clearly going to be worth more than a pound a year's time. So we're taking into account the fact that the investment will not be worth as much in future years. So we use that discount factor, that cost of capital, in order to represent the investment at current levels. So okay, just step back a little bit on that. That cost of capital will usually be told in the question, but you would normally look at it as having the interest rate on any borrowing that's required for the investment factored into it, plus the normal return on investment that the business would see. So we'd have a combination of those. So when we're considering net present value, we've got to consider that the hurdle rate is already included. So what we normally make is already included. So if you make a 0 net present value, that means you are making the normal amount that a business would make with their money. So anything positive is higher than their normal return, so it's obviously strong. So we've got to think about that when you're making a judgment. Now, normally, you're obviously comparing two different options in an investment appraisal essay. You don't have to be. So if you are, the higher the net present value, the better, because that means there's a higher probability of a profit. Well, there's a high probability of profits being generated. It's based on cash flow, but it is a higher possibility of profits being generated. Obviously, the higher the better. So one option has got a higher net present value. You say it's going to have a higher return. Therefore, this means the business will generate a high return on investment. They can use that for reinvestment. They can use it to pay dividends depending on what type of business they are, and that's perfect. If it was only one option, would be unusual, anything positive is a yes, because like we said in the first part, anything positive is higher than they would normally make with the money that they've invested. So something to consider. However, what net present value doesn't do is it doesn't consider the size of the investment. So if you're investing 20 million in one option and 40 million in the other option, clearly, just because the net present value is higher on the second option doesn't mean it's the best financially. But if we just look at it from net present value terms, it looks that way. So an additional calculation you could make is to divide the net present value by the investment, times it by 100, and to get a return on investment. And that gives you another comparison that you can make. And clearly, the business wants to make the highest net present value as possible. So the fact that they're investing more isn't necessarily a negative. But if it was the case of 20 and 40 million, is there something else they can invest the other 20 million in if there was a higher return on investment for the first option that could actually mean that we're generating more net present value overall? So just something to think about. So return on investment could be there. It's not a 100% accurate figure, but it is a comparison. It has been used and been credited and referenced in examiners' reports previously. The accuracy of the cost of capital. So we can't stress enough. So we're saying the normal return on investment, the normal interest rate, both of those could be questionable. So in the question or in the essay response, they could have told you how they get to the cost of capital. And so it would normally be the cost of borrowing or the normal return. So say the normal dividend paid shareholders, normal return on investment, whatever it might be. And so you've got to question that. So if it's interest rates, clearly if you've got a variable interest rates can change. So therefore the borrowing cost in future years may be higher than what we think. And the return on investment, it could be that you find more profitable investments in future years. And so actually, whereas this project looked extremely profitable or a lot more profitable than normal in the early years, as the business grows, is not the best option. So net present value, the accuracy of that cost of capital when we're making that decision, is something we can add as a limitation. We can question how that would affect your judgment and whether it is a accurate figure to use. The other part that's an issue is the accuracy of those cash flow estimates. So you're estimating how much cash we're going to make in the future. Now that is difficult to do. In the short term, it's easier to predict what a business is going to be selling in the next week, the next month, the next year. You can do that with a degree of accuracy. Sometimes these net present value essays are like 10, 15, 20 years. The longer into the future that you predict, the less accurate these cash flow figures are, and therefore the less accurate this net present value is. And if you're making a decision on investing a lot of money and these cash flow estimates are not correct, this really questions the legitimacy of what you're doing. So another limitation that you can have is how accurate are those cash flow estimates. What's the likelihood that you would sell more, sell less, costs would go up. We look at big investment projects, quite often the outflows for building projects far exceed what was initially planned. You look at Olympics, you look at council building projects, they quite frequently will be higher. And so that's something you can question and say how that could affect your analysis, and especially if the estimates, if there is some information in there which makes it questionable. There was an essay a couple of years ago which had the estimate of the building works based on another area of the country to where they were investing. That clearly affects the legitimacy of the estimates and the reliability of the data being given. So when you're weighing all of these things up, you've got to think net present value. Yes, the higher it is, the more profitable a business could be. Then we look at the potential return on investment. Then we question it and start thinking about whether it is an accurate measure or not. We do that and we approach our essays in that way, you're going to get far higher marks. Okay.